I'm here with Sheri Stefanich with Millennial Mortgage, and I'm super excited today to talk about mortgages in today's mortgage environment, specifically about mortgages for people that are purchasing properties $1 million or more. And I'm sure you're interested in this as well. A lot of things are going on, and we're going to give you some answers. So welcome, Sheri.
Thank you. Thanks for having me here.
Do you want to give us a little bit of an overview of what's happening in the mortgage business, $1 million or more with loans?
Right now, what we're seeing is we are seeing a high demand for luxury home purchases. We have quite a few of loan programs available in this market. We refer to this as the jumbo market. And there's a lot of different options for financing available to buyers right now.
Oh, very exciting. And would you say, Sheri, that it's busy in the luxury market in terms of people that are getting loans? What are you seeing?
Yes, I think so. It's stayed very steady. And we seem to have quite a few people moving here and relocating here for various reasons within that market. A lot of people are obtaining financing. They're utilizing their cash for other things and other investments and choosing to get the loan on the purchase.
Terrific. How does the current mortgage market and luxury market impact buyers wanting to get a loan for a luxury home?
So right now we've been in a high interest rate market for the last couple years, which the high interest rates have tempered sales financing in general over the real estate market. The demand for luxury homes still seems to remain strong.
Oh, I agree.
People that are in the luxury home market tend to have resources to offset the high interest rates, such as having a lower loan amount, utilizing a larger down payment to offset the higher rate to create a lower payment. So I think that's why that market is staying strong. They have the resources and the ability to keep it where it's manageable.
Terrific. Are you seeing any trends in the luxury market in mortgages compared to other areas of the country?
We are. In other areas of the country, we see that there are overlays being created in the luxury market. When loans step into the jumbo category, sometimes those loans are seen as a higher risk because of the higher loan amount. If an area is seeing negative trends or concerns for value, they have overlays that they put in place. And that is happening in various other states. However, it's not happening here in Southern Nevada, which is great news.
Can you explain what an overlay is?
Yes. So there are guidelines for all loans that meet the criteria of the investor. So whether it's Fannie Mae, Freddie Mac, FHA, whoever it is, VA, and then lenders can impose overlays, extra guidelines.
I see.
So for example, they can say the guideline says you need a 680 credit score, but the lender can say, no, we require a 700 credit score.
I see.
So just to make it a stronger profile, I guess, is why they do that. And they do it, again, when there's something that they're concerned about, if there's a declining market or unstable market, anything like that. So we're not seeing that here at all. We're actually seeing quite the opposite. We've had multiple new programs come out for the luxury home buyer, which is fabulous. It has opened up the options for financing. So we have various different options to fit different scenarios, which helps qualifications and approvals.
Sheri, what is the most popular program for a luxury buyer in Las Vegas today?
30-year fixed jumbo loan is the most popular product. The 30-year fixed is offering really low rates right now, comparatively speaking. There is a 20-year and a 15-year. Oddly enough, the 20-year and the 15-year sometimes aren't better than the 30-year. ARMs are becoming popular again. So they're short term, and sometimes those rates are more aggressive. So we are seeing people choosing to do ARMs as well, adjustable rates.
Terrific. So let's talk a minute about an ARM loan, and let's help the audience understand what is an ARM and what is the advantage of an ARM.
ARMs are typically used for short-term periods. So for people that are only planning on being in the house, say, for 5 years or 7 years. So there's a 5-year term, 7-year term, 10-year term, and the rate will be fixed for that period, and then it becomes an adjustable rate mortgage. And that adjustment depends on the scenario of the loan or the terms at that time. So they get the rate fixed for 5 years if they do a 5-year ARM. If it's a 7-year ARM, it's fixed for 7 years. So for somebody that knows they're only going to be living here for 5 years and then relocating, they're going to get a lower rate, possibly, and a shorter term fixed rate, but they know they don't need the longer term fixed rate.
So with the ARM, let's say that a buyer jumps into a luxury home with an ARM, a 5-year ARM. Let's say it's a 5-year ARM. At the end of that 5 years, they could refinance the home. Is that correct?
That's correct.
Okay.
Yes.
And do you find that that's what your clients do?
It depends. It depends on the rates. So in this market where we're projecting that rates are hopefully going to go down, if at the 5 years it starts adjusting, the rate can actually adjust down if rates are lower from where they locked in.
I see. So if the rates are lower, it could adjust down.
That's correct.
If it's higher, they would adjust up.
Correct. And there's a cap. There's a cap each year of how much it can adjust. And again, that would be determined by that particular loan scenario. So it would depend on where they're at the end of the 5 years. But yes, they could refinance if the 30-year fixed rate, was lower, or they just decide now they want a fixed term.
Can you explain how the interest rate is different in an ARM than in a conventional?
The investors usually, and it's not always, offer a lower rate on the ARM because it is fixed for a shorter period of time. So that's why it's lower, where in the 30-year, you're getting it fixed for the whole term of the loan. Once it starts adjusting, if it adjusts higher, they're going to make more interest on it adjusting. So they can offer that lower rate on the shorter term.
I see. Now, if they get to the end of the 5 years on the ARM, can you share what an example would be? And we know this changes all the time, but can you share an example of what an ARM might be and how that compares to a conventional in terms of rates? Knowing that the rates change all the time, but let's pretend it's today.
I would say if you say if the 30-year fixed rate was at 7.125, you would find an ARM rate probably in the low 6s.
Terrific. So this would be definitely a nice option for someone to lower their payment, at least for those 5 years.
Correct.
So let's talk about how luxury property financing differs from financing for standard properties. So the over $1 million compared to, let's say, a $500,000 property. What is the difference in the financing process?
When we're looking at luxury homes, we're stepping into non-conforming or jumbo loan requirements. So that process changes because the criteria change once you move from a conforming loan to a non-conforming loan.
Can you explain what non-conforming means and conforming?
Yes. So conforming loans are any loan amount up to $806,500. That's the new limits for 2025.
Oh, good to know.
Once the loan amount goes over that amount, it's now considered a non-conforming or jumbo. Those terms are used interchangeably.
I see.
Now you could have a purchase price that's $2 million and you can bring the loan amount down to the $806,500 and you're still in conforming limits.
I see.
So you can still keep the loan in the conforming loan limits. Once you move into non-conforming loans, the guidelines do change.
In what way do they change?
So there's typically a higher credit score requirement, a lower debt to income ratio is usually required, and a larger down payment. Those are the typical differences that you're going to see between a non-conforming and a conforming loan.
In terms of qualifications of the luxury buyer, are there specific challenges for the luxury buyer as it relates to their loan?
Yes. So some people that are purchasing in the luxury market are self-employed, and they may have multiple businesses that funnel through onto their tax returns. They may have multiple streams of revenue that come in, and so this can make their application a little bit more challenging. This is why it's very important for us to get all documentation up front for this market, to make sure that we have all of the tax documents that we need, all of the asset documents that we need, so that we can properly calculate income for qualification purposes. So we like to work in advance, a couple months prior before the home buying process starts.
So talk more about what you need to do in advance before the buyer even goes out to look at property. You say that in this more complex situation, non-conforming loan, that you are going to need documentation up front. Why is that? Explain why that's important.
It's very important to meet the guidelines of non-conforming loans. There are specific things that we must get and criteria that we must meet. Again, when we're dealing with self-employed borrowers, they tend to have complex tax returns, which is fabulous. They work with their accountants to lower their burden of taxes that they pay. And there are certain deductions that we can add back into their income. There are certain deductions that we can't. So it's really important that we get tax returns for all businesses and that we look at each business separately, what income is derived from each business, and work not only with the buyer, but with their CPA as well directly to make sure that we have K-1s, all documents. There's a lot of documentation that's needed when it's a business.
I see.
And then same with assets. We want to make sure we have all assets available so we can look at what's going to be left in reserves, what they have available for down payment.
Continuing on this same subject of the non-conforming loan with the luxury buyer who is self-employed, owns one business or several businesses, and talk about what your role is and what the underwriter's role is in this process.
Great question. My role in this is to meet with our clients, take a full application, and make sure that I have the picture for the underwriter. So my job is to make it very easy for the underwriter to go through and check everything to approve the loan. The better job that I do, the easier the underwriting process is. It's very important that up front I'm extremely detailed. Again, this is why we want all of the business documents, everything in the file, so that when it all goes in, there aren't any holes. There aren't any missing pieces of information. The underwriter can't approve the loan if there's missing documents or missing pieces of information or they don't understand. So my job is to paint the story for them and show them exactly what we're doing so they can go through each item, check it off, and they're approving the loan.
Let's talk about the underwriter for a minute and help the audience understand what is the role of the underwriter and how important are they in the process?
The underwriter's job is very important. They're the person that is ultimately approving the loan.
I see.
So the underwriter, we have many people in place between myself and the underwriter. We have processors, processing assistants. During that time, we're getting all the verifications that we need. So we provide the underwriter with all different kinds of verifications of employment, verification of social security number, all the documents to show her or him all the information on the loan is accurate. So the underwriter's job is multitude, is to make sure that it is all the information presented is accurate, that the information presented meets the guidelines for the loan that we are looking for approval, and to make sure that we have provided accurate documentation to meet those guidelines. And when they're approving that loan, they're taking on the risk for that company. So their job is very important.
So would you say that the underwriter is looking for evidence for the information that the buyer is providing, the proof and the evidence that what they're saying is true? And then my next question is, who gives the underwriter the power? Who do they work for?
They go through years of training. They have certifications to be underwriters. And to be an underwriter in the luxury market is extra training, extra certification. To be a VA underwriter, you go through specific certifications to be a VA underwriter and an FH underwriter, because the guidelines through all the markets are quite different. Mm-hmm. And so they have to have multiple certifications. When they become an underwriter, they have to do a certain amount of case studies. So their first so many files that they're underwriting are then getting looked over by another underwriter to make sure that, so there's a lot of training involved to make sure that they are doing everything according to the guidelines. And your first part of your question, yes, their job is to make sure that everything is represented accurately and true, and that the person qualifies for the loan that they're applying for.
Let's talk about interest rates. I'm sure everyone is interested in interest rates and how those are determined for a specific buyer. Can you go over the process on how it's determined what interest rate is offered to a luxury buyer compared to a buyer, let's say, in a $500,000 loan?
Interest rates are determined by various factors of the profile of the buyer. So credit score is one of, the most important factors. We're looking at credit score. Down payment will affect the rate, and reserves, which is the amount of assets that you have after your down payment and closing costs. So that also affects the interest rate. Typically, in the non-conforming jumbo market, the rates are slightly higher than in the conforming market. And this is usually due to the perceived risk to the investor of the larger loan amount. However, that's not always the case. Our interest rates on our jumbo loans right now are very competitive, and they are very comparable to our conforming rates. The other thing that can affect it on the non-conforming jumbo market, there are options to put less money down. There is an option where you can put 10% down. In that scenario, the rate is going to be higher because you're putting less money down. So typically 20 to 25% is going to get you the best rate possible or more.
Let's talk about creative financing. What about if someone doesn't qualify or doesn't want to move into a typical jumbo loan? What are some options in creative financing?
We have a few different options. This is in our portfolio financing options. We have an asset-based program, which is wonderful. This is typically for people who have had multiple tax deductions on their income taxes and don't want to utilize their tax returns. We have a couple different asset-based programs that we can use for them to qualify. We also have a 1099 only program where they don't use their tax returns and we only use 1099s, which is really helpful. And there are multiple other portfolio products available based on different circumstances, property type, and profile of the buyer.
It sounds like there's a lot of flexibility in what you can offer someone based on their circumstances.
There is. There's a lot more programs available right now, which really makes this market fun and fun to find the perfect program to work for our clients.
About down payments for the luxury buyer. What is the expectation for down payments for the luxury buyer getting a new loan?
The expected down payment is typically 20 to 25%. If you can put down 25%, that's going to give you 25% or more is going to give you the best rate on the financing. 20% is usually the minimum down. There are exceptions, as we discussed previously. There are certain programs, if you have a high credit profile and reserves, there is the option to put 10% down. The rate will just be slightly higher on that option.
Are there scenarios where a buyer could finance a lower down payment?
There is. There's certain programs that would allow them to have the lower down payment. The costs and the rate will most likely be higher, and there will be more reserves required to qualify for that program.
Can you help the audience understand what reserves are?
Yes. Reserves are PITIA, so it's your principal, interest, taxes, insurance, and HOA. The total monthly payment multiplied by the number of months of reserves. So typically 6 to 12 months is a normal amount of reserves required on a non-conforming loan, and that is required after closing. So meaning those funds have to be in your bank account after your closing funds are wired. So after your down payment and your closing costs, these reserves need to be in your account.
Is that the same for a luxury loan or a standard loan?
The luxury loans are going to have the larger amount of reserves needed. 6 to 12 months is typical. And also on luxury loans, some programs will require you to have reserves on other homes owned as well. So if you own a second home or an investment home, they can also require 2 to 6 months reserves on each one of those properties.
And just to clarify, they is the lender.
That's correct.
The company actually lending the money.
That's correct. Or it can be the guidelines of the program. Just because there are multiple different programs, those specific programs all have different guidelines.
I see.
So you could look at one that has less reserve requirements, and then this one has more reserve requirements, but maybe the one that has more reserve requirements is offering a lower rate. So we look at all of those factors when deciding which program to utilize.
Okay.
And on a conforming loan, yes, the down payment can be less. You can go on a primary residence, on a first-time home buyer can be 3% on conforming, and then 5 and 10% are acceptable on conforming loans for primary residence.
So for a client who wants to build a custom home, what is the process for that buyer?
The custom home process is a little complex and fun. There's multiple steps they have to take. There is typically 2 to 3 loans involved in the process. So the first step is the land. They can either get a lot loan, which will be a separate loan for the land, or pay cash for the land. Then they go into the construction portion, which is the construction loan. During that loan, the building begins, and disbursements will be given out of that loan as phases of the home are completed. Then once construction is completed, the loan moves into a permanent loan. And at that point, it's your final 30-year fixed, whatever you've chosen for your product. So it's multiple steps along the way to get you to your final loan.
So going back to the construction loan, and you mentioned there were disbursements. Who are those monies being dispersed to?
So the funds are typically held with the escrow company, or and then sent out to the contractor.
I see.
As it's being completed. So foundation is laid, they want to get paid, they have to submit, show the work is completed, then that gets dispersed. So it's as different things are completed.
So there's triggers.
Correct.
I see.
And the contractor or builder has to be approved by that particular lender.
I see.
So they need to be approved, licensed. Sometimes some builders will make them go through their own approval process to be able to work with their construction loan.
Okay, Sheri. So some of my clients want to buy a second home or a vacation home, which is very exciting. So what is the process for getting a loan on one of those properties, and how is it different?
The process is the same. We're going to request the same documentation, the same application. The programs that are available are different. So for second homes and investment properties, there is a slight risk perceived by the investor. So the rate is slightly higher on investment and second homes. The down payment is more, so you will be required to put more as a down payment. And then the fees might be slightly higher depending on where the rate comes in. That's pretty much the only differences. The investment loans may require more reserves as well. As we discussed before, there might be an additional reserve requirement compared to a primary residence.
So one of the things about Las Vegas that's very exciting is we have people visiting here from all over the world, and oftentimes they will decide that they want to purchase a property here and they want to get a loan. So Sheri, what is different for the foreign buyer getting a loan here in the United States and in Las Vegas specifically compared to an American citizen?
The loans for foreign buyers are fabulous. They are quite different. There's different programs within the foreign buyers. So for example, if they don't have a social security number, they allow for an ITIN number. That's one program. There's other programs. They do require a strong credit profile. If they do not have a credit score within the US, we have other ways to get their credit profile. So whether it's their country or through alternative documentation, they do have to have a history of credit and borrowing. So that is required. The foreign national loans also require a larger down payment. Typically between 30 and 40% down is required for the down payment. And then the rates are going to be slightly higher than your traditional conforming loans for your buyers that are here.
Sheri, are there tax implications for luxury home buyers that they should be aware of?
Yes, there are caps to the amount of mortgage interest that you can deduct on your tax returns. There's also caps to the amount of property taxes that you can deduct. If any person that is buying a luxury home would want to meet with their tax professional in advance to discuss the price point that they're buying in and how that'll affect their tax returns and their deductions that are allowed.
Good advice.
Thank you.
What is the outlook for the luxury market here in the Las Vegas Valley?
I think the luxury market is going to continue to grow over the next 3 years. We have so much growth here with the move of all the athletic teams coming here. We've seen an influx of that industry moving here. We have businesses that are relocating their corporate headquarters here for various reasons, tax benefits being the number one reason. We have a lot of, with those corporations coming in, I believe that market is going to continue to grow. We also have a lot of projections for other businesses being developed here, so I definitely think we see a lot of growth coming our way.
Sheri,
Yes.
what is your number one or top three pieces of advice for buyers that are going to be purchasing a home?
My number one piece of advice is get your loan through me.
Okay.
I will do a fabulous job, but for sure, make sure that you're working with somebody that is experienced. Somebody that has been in the industry for 7 years or more. Buying in the luxury market, the loans can become complex, and you want to make sure that you're working with somebody that knows what they're doing, understands complex tax returns, understands your situation, and is able to communicate that to the underwriter and make sure that you are in the proper loan.
Okay, terrific. And what should buyers look for when selecting a lender when they're purchasing a luxury home? What should they be looking for?
Years of experience, reviews, going and reading reviews to make sure that the person has that experience. Interview, I'd say interview loan officers to know that they have that experience to work in this market. And make sure that you're working with somebody that's available all the time to answer your questions, to work alongside of you, somebody that has the time to work with your CPA, your real estate agent, because it is a large purchase and there are a lot of people involved in the transaction, and you want to make sure you have a person that can hold everyone together.
Absolutely. What do you love about your job?
I love so much about my job. My number one thing that I love about my job is the people I work with. I love each and every person that I help get their loan. At the end, when they get their keys and they call back and they say they're so excited and they love their home, or they send me pictures, that's the best part.
Absolutely. And I can attest to that because you've done many loans for many of my clients, and I appreciate you so much.
Thank you. I appreciate you.
Thank you for joining us today. I'm Robin Yates-Gajar with Las Vegas Sotheby's International Realty, and you've been listening to Sheri Stefanich from Millennial Mortgage. Thanks for joining us.